Cost analysis. So firstly, we should know the meaning of cost analysis. Cost analysis is made up of two words, cost and analysis. Cost is the value of money that has been used up to produce something and hence is not available for use anymore. In economics, a cost is an alternative that is given up as a result of a decision. Analysis is the process of breaking a complex topic or substance into smaller parts to gain a better understanding of it. Thus, cost analysis means breaking the money that has been used to produce something into smaller parts to gain better understanding of it. Explicit costs are also called money costs. These are costs that a firm incurs when it pays for a factor of production while using it. Implicit costs are the costs of non-purchased inputs to which a cash value must be imputed. Thus, while we will include wages, interest, rent and capital in explicit costs, the wages foregone by owner, interest rates lost through purchases and so on. Actual amount paid or incurred as opposed to estimated cost or standard cost. In contracting, actual costs to date amount includes direct labor, direct material and other direct charges, while opportunity cost is the cost related to the next best choice available to someone who has picked between several mutually exclusive choices. It is a key concept in economics. It has been described as expressing the basic relationship between scarcity and choice. Transaction cost is the cost associated with exchange of goods or services and incurred in overcoming market imperfections. Transaction costs cover a wide range. Communication charges, legal fee, informational cost of finding the price, quality and durability, etc., and may also include transportation costs. Transaction costs are a critical factor in deciding whether to make a product or buy it, also called frictional cost. See also transfer cost. Search and information cost. This is the cost incurred to find out which product is available at how much price and at what place. Bargaining cost. These are the costs required to come to an acceptable agreement with the other party to the transaction. Policing and enforcement costs. These are the costs of making sure that the other party sticks to the terms of the contract. Fixed costs are expenses that stay relatively constant within a given level of sales. For example, the cost of renting a corporate headquarters is likely to be a constant amount, say rupees 100,000 per month, regardless of how much revenue the company generates. While variable costs, as the name implies, vary with the amount of revenue, a good example is sales commissions. More commissions will be paid if the company generates rupees 2 million in sales than if it generates rupees 1 million. After studying this lesson, you should be able to differentiate between explicit and implicit cost, actual and opportunity cost, and fixed and variable cost. Analyze total cost, average cost, and marginal cost. Analyze costs in short run and long run. Derive long run average cost curve from short run cost curves. Analyze the reason for the U-shape of average cost curve. Now let's further move on to discuss three major types of costs, which are total cost, average cost, and marginal cost. Let's start with total cost. Total cost TC describes the total economic cost of production and is made up of variable costs, which vary according to the quantity of a good produced and include inputs such as labor and raw materials, plus fixed costs, which are independent of the quantity of a good produced and include inputs, capital, that cannot be varied in the short term, such as buildings and machinery. Total cost in economics includes the total opportunity cost of each factor of production as part of its fixed or variable costs. We can write total cost as total cost equals to fixed costs plus unit variable cost into amount. Now the turn comes for average cost. Average cost is equal to total cost divided by the number of goods produced, the output quantity Q. It is also equal to the sum of average variable costs, total variable costs divided by Q, plus average fixed costs, total fixed costs divided by Q. Average costs affect the supply curve and are fundamental component of supply and demand. AC equals to TC divided by Q. Average cost equals to average fixed cost plus average variable cost. Marginal cost can be stated as the rate at which total cost changes as the amount produced. Marginal cost is the change in the total cost that arises when the quantity produced changes by 1 unit. That is, it is the cost of producing 1 more unit of a good. Mathematically, the marginal cost MC function is expressed as MC equals to dTC divided by dQ. All types of cost discussed above changes with respect to time, that is, short-run cost curves, long-run cost curves. There is no fixed time that can be marked on the calendar to separate the short run from the long run. The short run and long run distinction varies from one industry to another. The short run is a period of time in which the quantity of at least one input is fixed and the quantities of the other inputs can be varied. The long run is a period of time in which the quantities of all inputs can be varied. Short-run costs are those costs that can vary with the degree of utilization of plant and other fixed factors. In other words, these costs relate to the variation in output given plant capacity. Short-run costs are therefore of two types, fixed costs and variable costs. In the short run, fixed costs remain unchanged while variable costs fluctuate with output. Long-run costs, in contrast, are costs that can vary with the size of the plant and with other facilities, normally regarded as fixed in the short run. In fact, in the long run, there are no fixed inputs and therefore no fixed costs. That is, all costs are variable. We can see in the diagram also that short-run cost curves are steeper than long-run cost curves. Now let's discuss short-run cost curves in detail. They can be divided as total cost and output, average costs and output, average fixed cost AFC, average variable cost AVC, average total cost ATC, marginal cost and output. Let's start with average fixed cost. Average fixed cost AFC is an economic term that refers to fixed cost of production FC divided by the quantity Q of output produced. AFC equals to FC divided by Q. Average fixed cost is a per unit of output measure of fixed cost. As the total number of goods produced increases, the average fixed cost decreases, because the same amount of fixed cost is being spread over a large number of units of output. While the average variable cost AVC is an economic term that refers to a firm's variable costs like labor, electricity, etc., divided by quantity Q of output produced. Variable costs are those costs which vary with output. AVC equals to VC divided by Q. Average variable cost plus average fixed cost equals to average total cost. ATC equals to AVC plus AFC. A short-run marginal cost curve graphically represents the relation between marginal, that is incremental cost, incurred by a firm in the short-run production of a good or service and the quantity of output produced. This curve is constructed to capture the relation between marginal cost and the level of output, holding other variables like technology and resource prices constant. The marginal cost curve is U-shaped. The properties of the average cost, AVC, AFC, ATC, and marginal costs can be briefly described as follows. AFC declines continuously approaching both axes asymptotically. AVC first declines, reaches a minimum, and rises thereafter. When AVC attains minimum, FC equals AVC. As AFC approaches asymptotically, the horizontal axis, AVC approaches ATC asymptotically. ATC first declines, reaches a minimum, and rises thereafter. When ATC attains its minimum, MC equals ATC. MC first declines, reaches a minimum, and rises thereafter. MC equals AVC and ATC when these curves attain their minimum values. Furthermore, MC lies below both AVC and ATC when they are declining. It lies above them when they are rising. After discussing short-run cost curves, now we should discuss long-run cost curves, which can also be categorized as total cost and output, average costs and output, average fixed cost AFC, average variable cost AVC, average total cost ATC, marginal cost and output. The only difference is that these all are now discussed under long time period where the curves are less steeper than the short run curves. The long run average cost curve depicts the cost per unit of output in the long run, that is, when all productive input usage levels can be varied. The long-run marginal cost curve shows the minimum cost incurred per unit change in output when all factors of production are variable. The long-run marginal cost curve is shaped by economies and diseconomies of scale, a long-run concept, rather than the law of diminishing marginal returns, which is a short-run concept. We can see the diagram here also depicting long-run cost curves. After discussing both short-run and long-run cost curves, we can discuss that how long-run average cost curve can be derived from short-run cost curves. Each point on the long-run average cost curve corresponds to a point on a short-run cost curve, which is tangent to the long-run curve at that point. Plans of different sizes can be built in the long run, so a unique set of short-run cost curves exists for each possible plan size. Possible changes in the short-run marginal costs and average total costs leads to derivation of long-run average cost curve. As we can see in the diagram, also that a number of short-run curves are enveloped in a single long-run cost curve. At last, the topic for discussion is why long-run cost curves are U-shaped. Average cost curve is U-shaped because of the economies and diseconomies of scale. The curve shows relationship between cost and quantity produced in short run when labor is variable and in the long run when other factors of production are variable. When cost curve goes downward, it shows economies of scale, that is, gains and efficiencies associated with efficient employment of factors of production. The point at which the curve becomes flat or straight after going downward is the minimum efficient scale. At this point, average cost is minimum. After that, because of overemployment of factors of production, the average cost curve starts rising and results in diseconomies of scale. This explains the U-shaped curve of long-run and short-run average cost curve. After considering and analyzing all these factors, we can understand the concept of cost curve. Now let us check if we have understood the various concepts discussed in this lesson clearly. Long-run cost curves are more steeper than short-run cost curves. Right or wrong? Wrong. TFC plus TAV equals to TC. Right or wrong? Wrong. Long-run average cost curve includes various short-run average cost curves. Right or wrong? Right. Average fixed cost is derived after subtracting average variable cost from average total cost. Right or wrong? Right. Let's revise. Costs enter into almost every business decision, and it's important to use the right analysis of cost. Different business problems call for different kinds of costs, such as future and past costs, incremental and sunk cost, out-of-pocket and book costs, replacement and historical costs, etc. Fixed costs are those costs which do not vary with the change in the level of output in the short run. Variable costs change with output levels. The short run is a period of time in which the output can be increased or decreased by changing only the amount of variable factors such as labor, raw materials, chemicals, etc. Long run, on the other hand, is defined as the period of time in which the quantities of all factors may be varied. There are short-run average fixed cost and variable cost as well as long-run average costs. Total cost is the sum of total of the explicit plus implicit expenditure. Average cost is the cost per unit of output. Marginal cost is the extra cost of producing one additional unit.